The euro soared last week as expectation of a European Central Bank cut receded drastically following Draghi's post-meeting press conference. Strength of the common currency was impressive considering that the sleeping euro-Swiss franc also jumped over 100 pips and broke out from recent range. The Swiss franc was the second strongest currency last week, with the sterling lagging behind other European majors on weak economic data. The Japanese yen extended its recent sell-off on expectations of further policy easing from the Bank of Japan this week, as well as the fiscal stimulus package announcement from the government. Solid trade data from China boosted market sentiments in general and sent global equities higher, with the S&P 500 closing close to a newly made 5-year high. Commodity currencies also gained against the dollar last week, taken higher by risk appetite, with the Aussie outperforming others on its close ties with China. Technically, the strength of the euro should be noted. Euro-US dollar and Euro-Japanese yen have extended their recent rally. Euro-British pound also resumed the recent rise and has taken at a medium-term Fibonacci level, which suggests more upside is coming. Euro-Swiss franc also broke through a near-term resistance level at 1.2168. These are signs of solid buying behind the common currency. A major question is whether the euro could outperform the Aussie and loonie. Euro-Australian dollar and Euro-Canadian dollar showed strength last week but are both bounded in recent range. Based on the relatively unclear outlook in US dollar, Canadian dollar and Australian dollar, US dollar, we'd prefer the euro against them in the near term and favor an upside breakout in Euro-Australian dollar and Euro-Canadian dollar. Nonetheless, the Japanese yen will likely remain the weakest currency for the while. The speed of the yen's sell-off will very much depend on the outcome of this week's Bank of Japan meeting. In the U.S., the Bipartisan Policy Center said in a statement that the U.S. government will be unable to pay all of its bills as early as February 15. And it warned that, "We have less time to solve this problem than many realize, and the Treasury will exhaust its borrowing authority and no longer have sufficient funds to meet its obligations in full and on time at some point between February 15 and March 1. And it emphasized that it will be difficult to get beyond March 1. Also, the policy group predicts that a debt limit increase of $1.1 trillion is needed to fund the government through to the end of 2013. And another $1 trillion is needed for 2014. While the fiscal cliff issue was solved earlier this year, there are still much negotiation to be done between Democrats and Republicans on spending cuts and the debt ceiling. Meanwhile, U.S. President Obama nominated White House Chief of Staff Jack Lew to replace Timothy Geithner as Treasury. In the Eurozone, the European Central Bank left all its main interest rates unchanged in January, in line with consensus expectations. Thus the refinancing rate remains at 0.75% and the deposit rate remains at 0%. Most importantly, President Draghi stated that the decision was made unanimously. Economic weakness is expected to persist into 2013. Same as in December, the central bank expects to see gradual recovery later in 2013. Concerning inflation, the statement reiterated that it should remain contained, with inflationary expectations firmly anchored. Meanwhile, risks to inflation over the medium term are seen as broadly balanced. The euro was also lifted by a solid debt auction in Spain. Spain held its first debt sale in 2013 and sold a total of €5.8 billion in 2015, 2018 and 2026 securities, exceeding its maximum target of €5 billion. The auction showed solid demand at both the short end and the longer end, with the yield lower than prior auctions. And the result further affirmed the government's position in not seeking a bailout in the near term. Spain plans to raise as much as €121.3 billion this year. In Japan, Prime Minister Shinzo Abe unveiled a 10.3 trillion yen stimulus plan to boost recovery and end deflation. The plan is expected to boost GDP by 2% and create 600,000 jobs. Abe said that, We need to say goodbye to the shrinking economy and aim to achieve a strong economy where innovation and new demand leads to more jobs and income. 3.8 trillion yen will be spent for disaster prevention and reconstruction. 3.1 trillion will be used to stimulate private investments. The stimulus package is expected to be financed by a 13.1 trillion extra budget to be approved next week. And Abe said the government would also aim to achieve a primary balance surplus. It's also reported that the Bank of Japan would consider additional stimulus at its January 21 to 22 meeting this week, and might even double the inflation target from 1% to 2%. The yen has been deeply sold off since the new Prime Minister Shinzo Abe's push for a 2% target. And selling intensified as the central bank expressed its intent to review that price goal. Abe has also been pushing for bold monetary easing to revitalize the Japanese economy, and this has been priced in by the market. While the trend in the yen is still bearish, it will take something really strong from the Bank of Japan to impress the markets to accelerate the yen sell-off, like open-ended asset purchases, or eliminating the 0.1% interest rate floor on deposits held at the bank by commercial banks. China's trade surplus jumped to $31.6 billion in December compared to expectations of $20.1 billion. Exports rose an impressive 14.1% compared to expectations of around the 5% increase. Imports also rose 6% compared to expectations of 3.5%.